Well, good morning. Welcome to the Financial Pulse Show. I'm your host, Danny Howell, CEO of East Coast Tax and Financial Planning. Welcome. I hope everybody had a wonderful Thanksgiving last week. We certainly did. We spent our time with the family up in Ohio, and it was a great time seeing family and friends. But we definitely are happy to be back down in Florida, where it's sunny and a little bit warmer. It's actually started to get a little bit of a cold front here, but nonetheless, we're happy to be back down. I hope everybody had a good holiday, and going into the Christmas season, I just wish you a Merry Christmas, Happy Hanukkah. But most importantly, this show, I want to talk about market risk. And the reason why I want to talk about that, we talk quite a bit about this throughout the year on the show, because it's just, it's something very important to take into consideration when you're thinking about building your retirement and your savings. But risk is real right now, and it's back and just better than ever. In fact, I was reading yesterday and looking at the numbers, and if you look at fourth quarter so far of 2018, it's not been this bad for quarterly results on the S&P 500 for fourth quarter since 2008. And so that kind of sends shivers down some people's spine, I know. There's a lot of speculation on whether we're just in a simple correction where markets are supposed to correct, at the healthy thing for them to go through a correction to make sure that they don't get wildly overpriced and so forth, to hopefully not create too much of a bubble. But then there's other sentiment out there among analysts that we could be in a bear market already, given the fact that we pretty much erased all of 2018's gains on all the major indices. And so we're in this spot now of what do we do? And do we do anything? Do we just kind of stick by and hold? We had the elections, and we saw that the House did change hands, and so now we have a little bit more of a polarized, if not a lot more polarized government. And so that means a number of things. With a polarized government, that means there's probably not going to be a whole lot of legislative changes that happen because of the president's veto power, and the fact that it's going to be very difficult to get both sides of the aisle to agree on anything at this point. That being said, there's a lot of sentiment out there in the investment world that, the market's kind of like that because there's a little bit more predictability. When you're talking about legislative risk, meaning the risk that comes out of Congress, meaning we don't know what they're going to do. We don't know what kind of decisions they're going to make or what kind of policies they're going to put forth. There's no measurement for that. There's no historical preference. There's no historic reference that we can go by that says, okay, when we have this situation, that situation, chances are by this percentage, we're going to see this kind of law or legislation passed. It doesn't work that way. We can look at systemic risk. We can look at monetary risk. We can look at interest rate risk. We can look at all these different things, and we can look at history, and it kind of gives us a little story of what to expect. But when you look at legislative risk, it becomes really, really uncertain and can create either a real positive reaction or a real negative one. So going forward, it's going to be really interesting to see now that the conservative agenda is not necessarily going to be fully met with a lot of praise with the Democrats. Then we're probably going to see a lot less movement on that front as far as taxes and reform and things like that as it relates to the economy. But for you personally, what does this all mean, right? I mean, chances are you have an investment advisor or a stockbroker, financial planner, somebody that helps you make decisions. Maybe you're still working, you've got a 401k, and so at work you've got, a company that's just managing the 401k. Maybe you checked off a couple boxes and you keep putting in your money, hope you're maxing it out, and you're just dollar cost averaging in there. And when things are low, you're buying when they're low, and then when things come up, things are good. That's called dollar cost averaging, and that allows you to smooth out your returns over the years. But as we get closer to retirement, and especially when we have like 1 foot in the door of retirement, 1 foot out of the door of retirement, that's when we have to be really prudent. especially because we don't want to wake up financially disappointed in the fact that, oh no, we had another 2008 situation happen and, 20, 30, 40% of your money's gone, your retirement money, or, a 2000 situation where we saw after the tech bubble busted and we had the terrorist attacks and so on and so forth. Well, we don't necessarily have those events going on right now, but what we do have is a lot of uncertainty in the world with regards to just tension among governments. We also have, a market that has been in a bull run for so many months consecutively in a row. And now we're starting to see, things wobble a little bit. So what I want to make sure of is that our listeners and people that like to tune in, and maybe you're listening to this on a podcast, on our website. Our website is eastcoasttaxandfinancialplanning.com. And you could go there and you can listen to past radio shows, podcasts, our blogs, and things like that. But regardless of how you're getting this information, I want to make sure that fundamentally speaking, you have these things included in your financial plan. And one of the very first things when we're talking about risk, we're talking about the situation or environment that we're in right now. How do you make a decision going forward? How do you make a decision on whether you should just continue doing what you're doing and no changes at all, or whether you should take maybe a little bit less risk or a lot less risk, or whether you should double down and take more risk? And the answer to that lies in what I call the investment policy statement. And the investment policy statement basically helps take a lot of the emotions out of future decisions. The investment policy statement, your personal investment policy statement, basically helps you take the emotion out of your future decisions when it comes to investments if you're invested in the market. And that investment policy statement is a living, breathing thing. It can change according to how you feel about the world, about the economy, and so on and so forth. So even though it is there to help you manage your emotions as you're making these important decisions, it's also something that's fluid. It can change because, let's face it, money is emotional for us. And as we get older or as market conditions change, as life experience changes and so forth, and our environment around us, then we can revisit that investment policy statement to make sure it really truly aligns with how we feel. And especially if you're married, it's vitally important that both of you are intimately involved in crafting that statement with the help of a financial professional, obviously, so that you both are on the same page. You see one of the number one reasons why marriages, end up in divorce, and that's finances, right? Tension around finances. And so a big part of finances, obviously, is your retirement plans, your savings. And so, many people have never done an investment policy statement ever, or never did a true risk tolerance where they look at everything and they say, yeah, I'm fine with the potential of my investments falling within that range of down or up. Okay, so how do we create that investment policy statement? First, we have to get a risk assessment. So the risk assessment answers the question, the vital question of the risk-reward question, and that is, how much risk, how much upside am I looking for or how much downside potential, how much risk am I willing to take for the upside, the reward that I'm looking to get? And so you could start on either side of this coin. You can say, I refuse to take this much risk. In other words, if my investments fall below X, whether it's a percentage or whether it's a dollar amount, and I personally like the dollar amount. Somebody could say all day long, I'm fine with being down 5%. And then I say, okay, well, if you're fine being down 5%, you have $500,000 between all your investments and your nest egg, so you're fine losing $25,000. And then it's amazing to me how many people say, no, I'm not fine with that at all. That's too much money. So then all of a sudden the light bulb pops up and it says, wow, I've been thinking about this all wrong. Because if my investments were down by 25,000, not just 5%, but 25,000, that makes a whole other difference for me than if I just think of it in percentage terms. The other side of the coin you can start off with is, what is my goal? What is my reward that I'm looking to get as a result of investing? And most people start there. Like, man, if we could only make X, we would be just fine. And so finding the sweet spot of what do we need to make, reverse engineer, what do we have to earn on our investments in order to make sure we don't outlive our money, be able to maintain our lifestyle, take care of the things we need to take care of, and so on and so forth. For those what ifs in life pop up, we're still okay. What kind of interest rate do we have to get in order to do that? When we come back for the next segment, we're going to dive deeper in how that risk-reward conversation happens, how it plays into this current market, and how you can assess where you are now, how it works, how it affects you to make good, solid decisions moving forward. I'm Danny Howes for the Financial Pulse. We'll be back in just a bit.